This is Satya Pradyuman of Cirrus Research. The latest briefing report is just out. It basically summarizes all the damage that's taken place as the tariff wars have begun. The title, Crowding Dissipates, Tariffs and AI to Drive Rotation. What we're getting at here, the crowding model that flashed red at the end of January basically had forecasted a break in leadership. This is played out in textbook fashion for a number of reasons. But what's really changing now is that as that model has now come to neutral, the reality of the tariff wars are here, and the question as to whether or not AI spend will be as strong will now begin to drive the rotation in the market. This is our reading from our crowding model called the Cirrus Polarization Quotient, CPQ. What we're showing here is that the multiple on leadership stocks back in January had climbed to some unusual level. We call that basically a one-standard deviation above normal level. That has since corrected as leadership stocks have broken sharply in the last couple of months. So with a neutral reading, this idea of a crowding measure, this is now benign. That said, at the forefront is that we've got a ton of uncertainty regarding the relationship with our trading partners and all the elements that follow. Importantly, we've, really since the last few months, we've been very vocal about this idea that the second part of the story is this, the true leadership, which is AI spend. That has begun to slow slightly. When we look at NVIDIA's top-line growth, it's been decelerating for 4 quarters. What we're now starting to see is that some of the billings data is getting a little softer. If this trade war continues to move in the direction it's moving in, then the CapEx spending data will slow much more sharply than we expect. That is something we're watching very closely here. So in other words, what's going on is the overall market risks, but on top of that, really the sort of special part of the U.S. equity market the last couple of years, that will now come under even greater pressure because of its cyclical nature. The tariff components, we've been measuring the performance. I think what's shocking about this past few weeks is that the markets, as much as they had been reacting, the firms that were, let's say, most sizably exposed to various nations, we started to see downward pressure pretty much right after the election. But we also started to see relief in those stocks. In other words, investors started to think that there was more of a bluster campaign and not real. I think what we're about to see in these benchmarks now is a massive correction that has begun in the past week or so. This data is quoted through the end of March. So we expect to see many of these tariff beta baskets break sharply. So we'll keep you posted there. And then this idea about leadership and the rotation, it's been significant, but in terms of active performance portfolios, no surprise, the most undervalued parts of the equity market have outperformed sharply. Leadership factors such as price momentum, business momentum, they have broken down hard, more so in the large cap market than small cap market. But this is something that is likely to continue because you're looking at years of dominance in trending factors. There's plenty to unwind as we continue to move through these days. With any questions, feel free to reach out to us. Thank you.